Kia ora, welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. Sharesies is a wealth development platform whose purpose is to create financial empowerment for everyone. My name is Frances Cook. I'm the investments editor for BusinessDesk. Now we have a special offer for Sharesies investors from BusinessDesk. If you use the promo code SharedLunch2023, that's all one word, SharedLunch2023, you'll get $100 off an annual subscription to BusinessDesk, which is usually $249, including GST. Now, the offer only applies to new BusinessDesk subscribers, can only be used once per subscriber, and can't be used with any other discounts. It's also important to remember investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. You should review relevant product disclosure documents before deciding to invest. Now, today on Shared Lunch, 2023 has headwinds aplenty. From Chinese supply chain issues and an ongoing war to persistent inflation, interest rate hikes, and, to be honest, a likely recession. So what do the investment experts make of this, and what can you learn from them? We're talking to Pi Fund's founder and Chief Investment Officer, Mike Taylor, about how to ride this out and build wealth for the long term. Welcome, Mike. Thank you for joining us today.
Thanks for having me.
Oh, it's fabulous to have you on because, before we jump into this topic, which is, of course, hugely relevant, but you founded Pi Funds 16 years ago. You've been the chief executive for much of that time, but I think it's super interesting. More recently, you've jumped back into the hands-on investment strategy side of things. Why?
That's a good question to start off this podcast. So I think for me, and like a lot of entrepreneurs, when you start a business, one of the main reasons for doing so is that you want to work for yourself and you want to be your own boss. So as a consequence, you start the business, you're the CEO, right? You're obviously the CEO of nothing at the start. And then slowly, more people join and kind of fast forward that sort of 15 years. And Pi Funds are, we've got 46 staff now. And I guess the business had reached a point where much of the CEO work was very operational, day-to-day management. And if I'm honest, that's not really my passion. My passion always was investing, always is investing. And so I was an investor who wanted to have my own business. And then once the business was established, I kind of, as is your right, when you're an owner and a founder, you can kind of choose the job you want to do. So I've chosen to go back to being full-time investing.
What is it about the investing side of things that you find so interesting and so hard to leave behind?
So what I like about investing is that you get to learn about everyday businesses, companies that you use throughout your day. Could be Apple, it could be Spotify, whatever it is, as you get to learn and research about those businesses, which for me I find really interesting. But importantly, it's about trying to discover to something that others don't know, or to be able to beat the market. Essentially what you're doing is you are trying to predict the future. And of course, no one can really do that, but we all like to have a try. So if you can sort of build your skill around that, then yeah, it's quite enjoyable. And I enjoy kind of being right when I make an investment decision.
Don't we all? As I often say, the crystal ball is a little wonky, but we love to gaze into it nonetheless. So, all right, let's gaze into yours and see how wonky it ends up being. You are watching markets now all over the world on a daily basis. The Australian market, the UK, European markets, of course, the US market. So when you're looking at these global trends and the huge amount that is happening in the world right now, is there any sort of overall prediction or overall thought that you have as we head into 2023?
Look, I think when we came into 2022, just to give it a bit of context to start with, is that the market for last year caught most people by surprise, to a certain extent myself also, is that, the stimulus that came out of COVID and the strength of the bull market through that period was nice, it was fun. It was a great time to be investing. And it sort of ended quite quickly and quite abruptly. And so for most of last year, it was a brutal sell-off across all asset classes, whether it's crypto, bonds, equities, everything got smashed. And so it was a really hard year. And coming into 2023, sentiment was really down in the dumps. And particularly the sell-off in a lot of the technology assets right at the end of last year left the feeling is that, this year's going to be terrible. And so I think when you start at that basis where your expectations are really low, it doesn't actually take much to beat those expectations. And that's what's happened in January this year, is that, US inflation has come down quite a bit. I think we might want to talk about that in more detail later on. That's come down. Some earnings haven't been as bad as expected. We haven't heard any more rumblings out of the Ukraine for a while. I think we've all become a bit numb to that, quite sadly. And so you had the stage was set for a decent market rally, which is what we had. Some people will say, it's the trash that's rallied, everything the most shorted, Tesla's up, like 60% in a couple of weeks. So people are still buying Bed Bath & Beyond, even though it was bankrupt. So there's been a lot of things that have rallied, but I think essentially there's that the sentiment was so bad that it enabled some less bad news to cause the market to rally. So for the rest of the year, I think that's going to sort of be the backdrop, is we're going to keep shifting between some good news, some bad news. Are we in recession? Are we not in recession? And so my view for the year is quite choppy, quite a sideways driven market, ups and downs, challenging to make money, easy to lose money.
Yeah, it's interesting there when you say it was basically everyone had such low expectations. Really lower those expectations, and then you have less terrible news, and it suddenly seems like good news. That's very, very true for how things were over the course of the last year or so. I mean, we often talk about, we've already said everyone loves to gaze into the crystal ball and try to predict the future. I mean, that is often the game here. And a bit of jargon that people often talk about is what the market has priced in. The idea that there are certain things already expected or certain things that have happened, and we know that they tend to have certain impacts further down the line. So investors, people in the market, companies will often take, ideally, a longer range view on how things are going to go. And you can see these things getting what we call priced in, because people are already acting as if those things have happened because they expect them to happen. So what sort of things are we seeing already getting priced in the markets now?
So that will depend on country, sector, and then obviously down to a specific stock. So for example, at the end of 2021, you had priced in that interest rates would remain at zero sort of forever, basically. That's why stocks were bid up the way that they were. At the end of last year, we were priced like interest rates were going to just keep going up, maybe 6-7% type thing. I even remember reading on some forums that, oh no, RBNZ is going to take it to 10%. So there was some expectation or some fears at least that that's what was going to happen. So what's priced into the market now? Look, we've had a bit of a rally. So I think some of the good news that we've just explained is in the price, if you will. So probably by the time this podcast goes out, the Fed will have met. They meet Thursday morning, New Zealand time. And the expectation for that is a 25 basis point rate rise. And also that they will continue to kind of talk the market down. They don't really want the market to rally away at this point. They want to keep talking hawkish, keep saying that they'll keep rates high for the remainder of the year. Because the last thing they want to do is just kind of throw some petrol back on the fire that they kind of trying to put out, which, by the way, they started in the first place, but we won't go there. So, that's the expectation for the moment. What would cause markets to shift would be if they raise rates more than that, or if they were particularly dovish, of course, rally to continue. So I don't expect too much from the Fed this time to drive markets. But what we could see, I suppose, moving things in the next few months is corporate earnings. There's still quite a few S&P 500 companies to report in the coming weeks. Some big ones tomorrow.
Well, exactly. Yeah, we are well into earnings season, and it is an interesting time of the year, right? Because you do get a look at some of the nitty gritty behind these companies, and it can change things for investors. So when you're looking at these earnings as they get released, I mean, we've got all of these economic headwinds that we've touched on already: inflation, war in Ukraine, interest rate hikes, honestly, still the COVID recovery. And so when we're looking through these earnings, what sort of things are you looking at? And how can you weigh up some of the best investment options and the best performance, especially when we're thinking retail investors?
Yeah, so what you're looking for is the outlook statements, because that will give you an indication of what the management team is expecting for the near future. I mean, most companies don't have that much visibility of their earnings anyway, but it's usually the sound bites, the snippets you get from the CEOs to talk about whether they're seeing, slowing demand, wage increases hurting their margins, cost pressures. A lot of the things that companies were talking about 2021, early 22 have gone, which is supply chain problems. Those have all resolved now. And freight costs, those types of things have normalized. We're not having the same challenges with commodity prices as well. They've come back down. And also you're looking for earnings resilience. So you might be familiar with the company Brunskill, which does sort of pest control. I read a comment today from their CEO to say that people don't defer spending on pest control. If there's a rat running across your kitchen, you get it sorted, regardless of, whether you think the economy's
certain things are always a priority.
Yeah. Yeah.
Well, that's very true. And I mean, this is why that, we often talk about certain things being safe haven investments. And let's stick with shares for now. Things like supermarkets, energy companies, often considered safe havens as we are looking at recession, not just in New Zealand, but around the world. Is that impacting your investing decisions right now?
So your companies, consumer staples is what they typically call them, are considered defensive investments that you might want to put your portfolio in during periods of uncertainty or economic slowdowns. However, everybody's already thought of that sort of 12 months ago. So those companies are quite expensive at the moment. And also they're not businesses that they're great growers. Typically they're just growing at GDP type levels. So you might have to pay a reasonable price or a high multiple of their earnings to get a business that's not really growing. So that's the downside. And of course, the other challenge could be is that we've seen this quite a few times since COVID, is big rotations within the markets. So, for example, when the vaccine was first announced, there was a huge rotation into sort of recovery names. And then we saw a rotation into companies that would benefit from online spend. Last year there was a rotation into energy companies and healthcare. So you got to be aware of these rotations, that we could have a rotation out of defensives at some point this year and back into high growth. And we've seen a little bit actually to start that in January. I think healthcare and energy is off a couple of percent versus tech. The NASDAQ's up 9 or 10% for the month.
We're going to come back to that because that is a really interesting point of how long a view often the market does take on things. But I'd like to stick with for a moment, because I just said there about, sticking with shares, but there's plenty of other investment types around that might make up part of someone's portfolio. People have been asking about, is gold a safe place to be? It's been unpredictable in bonds. Are they still a safe place to be? When people are thinking about a properly diversified portfolio, not putting all your eggs into one basket, but making sure you've got a bit of this, a bit of that. How much should these types of other investment types be part of consideration for your mainstream retail investor?
Look, I think you need to consider all types of asset classes, but for the mainstream investor, you should probably look at shares, property, cash. To be honest, and right now, you can get a term deposit of 5 or 6%, which is pretty attractive. I think by the end of the year, inflation will be below that, so that's not a bad outcome in a volatile environment. So it's definitely worth considering cash again, which we haven't been able to do for a long time. Most Kiwis are pretty good at property, so if they don't know, there'll be a family relative who's more than willing to give advice. And shares, I always think just invest in what you know. If you know a business, then there's a good chance you'll have a reasonable view of what their likely outcome is, or their likely future is. Bonds can be quite complicated because you have to understand the yield, also the implied sort of risk of that corporate, and then they sort of move inverse to what shares do. So,
well, except for 2022, but yes.
Yeah, so unless someone's got a real interest in it, it's probably better to avoid those.
Yeah. No, it's interesting, right? Because you mentioned there, just a few minutes ago when you were saying about some of these investments, they priced in these various movements 12 months ago. And so the market, obviously the market is made up of people, but it's easier for us to just talk about the market, as a general group. We do see people
now. It's made up of machines as well.
Well, true. Yes. So people, companies, AI, it's all happening now. But when we're looking at things, it does often take a longer term view. 6 months, 12 months, it can be looking ahead. And you've said previously that the share market often bottoms out about 6 months before the wider economy bottoms out and starts to climb back. So if we're taking that long-term view and trying to predict how things go for shares, what do you think is going to happen there first and second half of this year?
Yeah. Well, it's plain to see at the moment that the economy is still slowing. House prices are still falling. And, generally retail spending is slowing, not as fast as the Reserve Bank would like, but, the economy is slowing. It's taking a long time to slow things down because of the stimulus that was provided through COVID, people having built up savings, et cetera, et cetera. But, that kind of 6 months thing is a bit of a rule of thumb. It's not hard and fast. If we were to say that the low for stocks was December, that would imply that the broader economy bottoms out in the middle of the year. If you have a view that it's not going to bottom until the end of the year, then you'd expect stocks to make a new low this half, essentially.
And it is, as we've said before, this is all our best educated guesses. We do not have access to the future, unfortunately, otherwise we'd all be very rich. But, more positively, because there is always some good news, as we've already mentioned, with interest rates going up, of course, we all see people getting upset about debt, but as you've said, term deposits now are looking incredible. So there's always a pro and a con to things. So is there anything that you're excited about in terms of markets at the moment? Any silver linings?
Yeah, there is a lot of investment that is going into and needs to go into renewable energy and infrastructure there. So there's a McKinsey study out last year that says an extra $3.5 trillion needs to go into that sector every year until 2050 to meet the net zero targets. So that's a massive increase in spending globally that's required. So if you can look to find companies that are going to benefit from that one way or another, then they've got great tailwinds for the next 30 years, essentially. Now, there'll be ups and downs in that, and they might get overvalued and undervalued, but as a general theme, that's a good place to go looking. So we've done a bit of looking in there, and we've got quite a few companies within our portfolio. focusing on that. It's quite hard to find them in Australasia, to be honest. If you look at Australia, they're still very much old world in terms of what they dig up out of the ground. Obviously in our own market, we're pretty fairly limited.
Yeah. What sort of markets do you look to for those opportunities?
There's a lot of companies in Europe that are renewable energy providers. Throughout the US, also through Asia, you can find companies that manufacture sort of a componentry for wind or solar. And then there's various businesses throughout the world, really, which might have a focus on energy efficiency, for example. So we've got a few of those that are in the portfolio too. So yeah, having the ability to look outside New Zealand, and we've got a team based in London, really helps us kind of unearth some great businesses.
Wow. And there have been, as you say, there's a lot of changes around really anything associated with climate change or even wider environmental social governance principles, the ESG that we hear so much about. Do you see that continuing to be a really big impact on the market? And is it challenging to stick to promises in that area for companies?
Well, ESG, I was talking to my partner about this last night. It's a bit of a journey for people. Maybe those people who are climate change deniers have a slightly different view after the rain in Auckland recently. But, even within our own businesses, within Pi, we've got people who are real advocates, real believers in responsible investing in ESG, and those are the ones who are on our kind of ESG committee. And yet there are still people who really think we should be investing in oil companies still within the business. So there is a view. Obviously, we have a company view, but that's just within our organization. So if you can imagine what the view is like globally, it's going to be exactly the same, just on a larger scale. So, I think at the moment, probably Australasia as a region is a little bit behind with in Europe, for example. And I'm not quite sure on the US, but it sort of anecdotally feels like they're a little behind Europe as well. So in the other point, in terms of breaking promises, I think that, we've legislation coming in to kind of test views on that, particularly for our industry, starting next year. So it will get more real quite soon.
Yeah. Do you think with those new reporting requirements coming in, as you say, very soon, is that going to be a little tricky for companies? Do you think the New Zealand environment is ready for that?
It will be quite challenging to actually complete that reporting. There's a few things that we have to work through to try to understand that, because it might be easy to obtain the data on a large business, but it will be quite hard or challenging to find data on a smaller business, and might require quite a reasonable amount of guesswork, at least in the beginning. So I'm not sure how accurate the data will be for the first few years, but I guess you've got to start somewhere. So the idea would be sort of within maybe 5 years, the data will be quite reliable.
Right.
Yeah. And will help investors make decisions.
Now, we've touched on this, but it's an interesting area for a lot of people, so I'd love to dive in a bit more depth. The tech sector has been absolutely hammered, totally in the doldrums over the last year or so. Some commentators have said this has been an emperor's wearing no clothes moment, that it doesn't have a future. What are your thoughts on how the tech sector has gone and what its future might be?
So what's new technology today? For as long as there've been markets, we've always had a new technology. And what's, new today will be old in 10 years type thing. So, of course, there's going to be new technology, and it's going to require venture capital, private equity, and investors like me to continue to help fund and grow those businesses. So nothing's really changed there. what happened during COVID, in some ways a little bit similar to the tech bubble from 99, 2000, was that there's a lot of free money floating around, and some ideas got funded when they perhaps shouldn't have got funded. And I don't think it was as extreme as that 99, 2000 bubble, but certainly valuations were high, multiples were high for businesses. And, with changing interest rates and less money floating around, those valuations have changed. And so if tech companies want to raise money today, it's at a different valuation multiple. On top of that as well is that we got used for a period of time to just funding growth forever with no profits in sight. Whereas now there's a greater expectation that you've actually got to deliver some level of profitability.
Yes, it is. It is interesting, isn't it? Maybe a bit of a cynic, but I like to put a lot of salt on everything that comes through, because I do think there can be certain parts of the market that swing wildly from black to white, and yet there's so much gray in the middle. And I think sometimes people will get very excited about the potential of new companies, new sectors, and they'll go all in on it, and then it hits a speed bump, and they run away screaming. And I don't think necessarily either view is 100% correct. I mean, we see things like AI coming through just in the last few weeks. There have been huge developments in AI, at least publicly. It looks to me like there are still plenty of areas with a lot of potential, right?
Oh, for sure. It's just often when you get that emergent technology, you don't know who's going to be the winner. And the company that you invest in might not be the winner. And someone else might, and the one that gets bought by Microsoft probably will end up being the winner, so that's just how it goes. And also it's a bit like the streaming services, is that there might be a large number to start with, but as time goes on, you have to sort of say, okay, well, I'm only going to commit to these 3 platforms or these 3 streaming because that's all I can afford, or that's all I want to, or there's too much content or whatever. And so that's how you narrow it down. And the same will happen with AI. It's just at the beginning, there's lots of players, and then that narrows over time.
Someone has to emerge triumphant, and it's extremely hard to pick who that will be. I mean, speaking of AI, there's obviously companies to invest in for investors, but there's also the possibility of AI impacting how you invest itself, it becoming part of your strategy or how you put money in. How do you see AI possibly impacting investing? Could it change how we invest?
I guess it could. At the moment, I think there's more money that's passively managed than there is actively, like people like me. So essentially that means that there's, more money just tracking an indice. Potentially it creates more opportunities, because I'm not sure that all AI models will be exactly the same. They'll be developed by different asset managers with different angles to them. So ultimately they'll still be doing what they're designed to do, right? So there's still someone doing the coding in the background. I think it could make the market more volatile. I certainly feel like with program trading and what we've seen the last couple of years, markets are moving faster, and people are switching sectors, stocks relatively quickly, which is a change from when I first started in my career.
Interesting. So when you first started, do you think people took a bit more of a considered approach, or was it simply that there wasn't the ability to trade as much?
Well, passive investing was, just emerging 20 years ago. So that really wasn't a factor. And you're very unlikely to have these huge sector rotations that we see now, where you can have massive one-day moves. And it's almost like the sector reprices in a day based on new information, which wasn't necessarily the case previously. It took a long time for information to filter through. So now it doesn't. It's just, yes, it's going to reprice in a day.
Yeah. No, it is. It's very interesting, the speed at which things move now. I think everything is just getting faster and faster constantly. I would agree with you that I think if AI gets involved, we'll just speed up even more. The ride that crypto has been on, I feel like we can't talk tech without talking crypto, at least briefly. We saw FTX have a huge crater. Speaking of cratering stocks, I mean, FTX just entirely fell apart in a screaming heap. Spooked a lot of investors, I think kind of fair enough. Do you think this is one of those things where it's a growing pain for the emerging asset class of crypto? Or is this one of those things where it is a huge red flag and possibly casts a shadow of doubt on legitimacy of crypto in general? What are your thoughts?
Well, the problem for crypto, I see it, is that it's designed to operate in an unregulated environment, right? That's the whole purpose of having cryptocurrency. Yet if you operate in an unregulated environment, then you get people losing their money like they did with FTX. So you can't have it all. So if you operate in a regulated environment, then a lot of the benefits of crypto will disappear and you'll end up being controlled by, essentially by the US. So I'm not sure what the future for that holds. Everyone always says that there's a benefit to the technology behind it, which I'm sure there is. And at some point they may end up having digital currencies around the world. That's probably highly likely. Personally, never been an investor in crypto, too volatile for me. I can see why people might have liked it at the early stage. I'd be less interested in it now.
Yeah, I've got to say, I've never personally been into crypto for exactly the reason you mentioned. I mean, well, a couple of reasons that you've already mentioned. When you talked about we have all of these companies come through and one might emerge victorious, but you just don't know which one. I mean, I see so many coins and I have no idea which one's going to be the winner. So I'm not going to try to guess, but also for the unregulated angle, that's just not for me. But to each their own. I mean, when investors are looking at this overall environment, there are highs, there are lows. And often the investing game is a long-term one. So if investors are looking at this and thinking, okay, how do I get through this? How do I ride it out and make the best of it for me? I mean, is there an overall point that you think that people should bear in mind in order to help guide some of their decisions?
Yeah, I mean, the best thing to bear in mind is that as an investor, you want to just continue to keep investing through ups and through downs. So regular investment, like you do with KiwiSaver, every month money goes in regardless, because we all get swayed by our emotions. We always want to buy at the top and sell at the bottom. So if you just got a program that money goes in every month, that's generally the best way to invest, and that's how you compound your wealth. It's kind of as simple as that, really.
Are there any mistakes that you think people should avoid this year, or is it sort of the flip of that, of not getting spooked and running away?
Well, I think if people, so what we try to do with as an investor is make sure you stick to your strategy, whatever your strategy is, unless you think it's fundamentally broken. You stick to what you're doing. So if you're a value investor or you're a growth investor, don't try and switch halfway through a cycle. Stick to what you do. Stick to what your knitting is. If you really like investing in, the household names, then keep doing that. But if you don't, if you want to try and unearth something else, it's not for you. Or if simply you're really happy investing in only New Zealand companies, then just stick with that, is what I'd say. When you try to venture outside your circle of competence, that's when things go wrong.
Yeah. Oh, really appreciate that, Mike. Thank you for your time and your insights and sharing all your knowledge with us today.
Pleasure. Thanks for having me.
Now, Shared Lunch is back next week. You can watch Shared Lunch on YouTube on the Sharesies channel, or you can follow us on Apple, Spotify, or wherever you get your podcasts. While you're there, do leave us a rating and a comment with who or what you would like to hear about. Until next time, enjoy the rest of your week. Stay safe.